Do you remember getting those paper savings bonds as a kid? And you're like, alright, whatever you say, Grandma, watch me slam these POGs. But now you're sitting here watching a YouTube video on how to buy them. Alright, bottom line is you have until October 28th to ensure you get the 9.62% rate on your Series I savings bonds. In this video, I'll briefly touch on the two types of savings bonds offered by the US Department of Treasury, why you should consider them, and then I'll walk you through the two different processes of actually purchasing I-bonds. So, the US federal government provides us with the opportunity to purchase two different types of savings bonds. And it's really an opportunity for both us and the government, since we're technically lending the government our money, which they can use for whatever nonsense they're getting into these days. But we benefit from them as the government pays us interest on the money that we lend them. So anyway, these two types of savings bonds are called Series EE and Series I bonds, and they each have distinct differences that can help you achieve different goals. Series EE savings bonds currently have a super low interest rate of only 0.1% yield, which on face value honestly makes these bonds look like a turd. But the real value these EE bonds have is that if you hold them for their full maturity date of 20 years, they're guaranteed to pay out double of what you paid for them. And since they double over 20 years, that gives them an effective annual return of 3.53%. But you really must hold them until they fully mature at the 20-year mark, because otherwise you'll be getting next to nothing as far as interest goes. So as you can see, these EE bonds are certainly not a good option for short to medium term goals, but rather for the long haul. These can be a nice supplement to investing in the stock market, as they have a much safer risk profile with guaranteed returns. Well, nothing is 100% guaranteed, but this is about as close as you can get. And if the US government stops paying out on savings bonds, then we probably have some serious issues. So we covered how EE bonds are good for the long haul, as they double in value if you hold them for 20 years. But they really aren't a good option for short to medium term goals. That's where I-bonds come in. They protect your money from being devalued due to inflation, and right now in 2022 is a really attractive time to buy them. Since inflation has been record-breaking over the past couple years, the current I-bond rate is 9.62%. Now, this is a guaranteed rate for the first 6 months that you hold your I-bonds. And in order to lock in this 9.62%, you must be issued your bonds by October 31st, 2022. And this means that you have to actually complete the purchase of your I-bonds by October 28th to ensure you get them issued to you by the 31st. And before we go through the entire process of buying I-bonds, I want to expand a little bit more on the interest rates and stipulations that these bonds come with. Firstly, the interest rate these bonds pay out is a combination of two different rates: the fixed rate and the semi-annual inflation rate. Now, when the Department of Treasury shows you that you'll be getting a 9.62% interest rate, they're displaying it as an annual rate. However, since I-bond rates are adjusted semi-annually, you're really only guaranteed that rate for 6 months. This means that 9.62% interest rate will actually pay out 4.81% over the course of those 6 months. So say you bought $10,000 worth of I-bonds right now at the 9.62% interest rate. 6 months down the road, those I-bonds will be worth $10,481. But since these rates ebb and flow with the average inflation rates, your bonds will begin earning the newly calculated rate beginning 6 months after you initially purchase your bonds, and then every subsequent 6 months that you hold your bonds. And if you take a look at the screen, you can see that your interest rate is going to change depending on when you actually purchased your bonds. The nice thing here is that even if you purchase your bonds right before the new rates come out, you'll be able to take advantage of the current rate for an entire 6 months. So for example, if you purchase I-bonds in late October, which is right before the November rate begins, your bond's interest rate will be 9.62% until April 1st the following year. And that's a good thing, because I-bond interest rates are predicted to go down to about 6.48% for I-bonds issued November 1st and later.
But Josh, won't I then only be getting 5 months worth of the higher interest rate if I purchase my bonds near the end of October?
No, and that's because no matter what day you're issued your bonds, whether it's in the beginning of the month or the end of the month, you'll still get the full amount of interest for that month. And this is great, because the thing about I-bonds is that you must hold them for at least 12 months before you're eligible to cash them out. But since the Department of Treasury gives you credit for the entire month that you purchase your bonds, it technically means you can get away with holding them for only 11 months and 1 day before you're eligible to cash them. Now, there's one very important thing that you must realize before you cash your I-bonds. And that's if you sell them before the 5-year mark, you'll pay a small penalty in the form of 3 months worth of interest. So, quick scenario. You buy $10,000 worth of I-bonds at the 9.62% rate. which means your bonds earn $481 once you hit the 6-month mark. Since I-bonds compound semi-annually, this $481 gets added to your bond principal, meaning your bonds now have a value of $10,481. But the rate for the next 6 months drops down to 6.48%, meaning you'll earn half of that, or a total of 3.24% over the next 6 months. Since we're now earning interest on our compounded value of $10,481, we've earned $339.58 for the second 6-month period of holding these bonds. But an emergency comes up and we need to cash out the bonds in their entirety once the 12-month mark hits. Since the penalty for cashing out before the 5-year mark is the last 3 months of interest, we lose half of that $339.58, which equals $169.79. We cash out our bonds and walk away with $10,650.79. For me personally, I love the idea of holding my emergency fund in the form of I-bonds. A really nice strategy to follow is called laddering, and it simply means you take your money and buy I-bonds at fixed intervals instead of all at once. By doing this, you can slowly transition your emergency fund into I-bonds without having all of your money tied up at the same time. An example of this could be instead of buying $10,000 worth of I-bonds at once, you buy $2,500 worth of I-bonds every 6 months. By doing this, you'll always have access to at least half of the $10,000. This is because once you're ready to make your third $2,500 I-bond purchase, your first $2,500 I-bond purchase will be out of lockup and be eligible to be cashed out. Of course, these figures were just an example, and your particular situation will differ. However, the process of cashing out your I-bonds does take 2 to 3 business days, and your money will be deposited back into the account that was used to purchase the bonds. But the government does limit the amount of I-bonds you can purchase. The minimum you can buy is $25 worth of I-bonds, and the maximum you can buy is $10,000 per person per calendar year. Now, there is a way you can get an additional $5,000 worth of I-bonds each year, but it requires you to purchase them in paper form through the tax time purchase program. And essentially, this means you'd have to purchase the paper I-bonds with your tax refund. Now, obviously, this means you need to actually have a tax refund to be eligible for this. And I personally try not to have a tax refund because I view it as giving the government an interest-free loan throughout the year. I like having more money up front, but I do understand the excitement that comes with getting a decent chunk of money back from the government every year. Now, an important note about being able to buy an additional $5,000 worth of I-bonds through your tax return is that this $5,000 worth of bonds is per tax return, not per person. So if you're married and filing jointly, you and your spouse are only eligible for $5,000 in total. But now the fun part. Let's buy some I-bonds. So first things first, we'll need to open a new Treasury Direct account if we don't already have one. If you already do have one, you can go ahead and skip to the next section where we actually purchase I-bonds. So as we can see, there's 3 steps to opening a new account. First, we must choose the type of account we're opening, then we have to provide our personal information, and then we'll choose a password and security questions. Now, for the purposes of this video, we'll be opening up an individual account. But there are other options that we can choose from if you have a business or even a trust that you'd like to purchase I-bonds with. So we'll choose individual and then click submit. Now, as we can see on this page, we'll have to plug in all of our personal information with the required fields being noted with a red asterisk. Now, where it says taxpayer identification number, you'll want to plug in your social security number. If you were opening an account for your business, you'd either have to put in your social security number or your entity's EIN, depending on how the entity is structured. And at the bottom of this form, you'll also have to fill out your bank information. Now for this, you'll simply need your bank's name, routing number, account number, and the name on the account. Pretty straightforward so far. So I'm going to go ahead and fill all this information out. Now at the very bottom, you'll see a checkbox for you to certify that you meet the 3 criteria listed below it. Number 1 is to certify that your taxpayer identification number is your correct number. Number 2 is confirming that you are not subject to backup withholding. If you are subject to backup withholding, you'll probably have received correspondence from the IRS telling you that you are. And for someone that is subject to backup withholding, it essentially means the IRS requires 24% to be withheld from payments made to them. Now, being subject to backup withholding can be caused by failing to provide your TIN, providing an incorrect TIN, or failing to report interest earned. And number 3 simply certifies that you're a US person. So if you're a US iguana, for instance, you may run into some hiccups. But they do include a handy dandy link here where you can check out the definition of a US person. So anyways, let's click submit and move on to the next page. Now on this page, you'll be able to certify all the information you've entered thus far is indeed correct. Once we confirm we're good to go ahead and click submit. Now on this page, we'll have to select our personalized image and caption of our choosing, which simply lets us know that we're on the authentic Treasury Direct website. So choose your image and caption and then click submit. Now we enter our password reminder, and 3 security questions. Once you've done that, we'll go ahead and click submit. So now they're going to send us an email with our account number, which we'll need every single time we log into our account. Now that we have our account number, we can go ahead and log in so we can purchase some I-bonds. Once we enter our account number in the login page and click submit, they'll email us an OTP, which is a one-time passcode. Get it from your email, plop it in, and click submit. And now we'll be presented with that personalized image and caption that we selected earlier. As long as that looks familiar to you, we can go ahead and enter our password. But as you can see, we're forced to use a virtual on-screen keyboard. Now, the good thing about being forced to use a virtual keyboard is that keyloggers won't be able to steal your password. Now, the bad thing is that it's a complete pain in the butt, especially if your passwords are random strings of characters. However, passwords on this site are not case sensitive, so at least you won't have to worry about messing that part up. And a little tip when you're using the Treasury Direct website is to never use your browser's back button. If you do end up clicking the back button, it'll log you out and you'll lose all of your progress. And then you're going to have to spend 20 minutes typing in your password on the virtual on-screen keyboard again. So now that we've entered our password, we can click submit where it'll bring us to our My Account page. Here you'll be able to see your current holdings, and in order to go ahead and buy new I-bonds, we want to take a look near the top left of the screen and click on the Buy Direct tab. You'll see a bunch of different options, but we want to take a look down under the Savings Bonds section and then select Series I. And since we want to purchase I-bonds for ourselves, we want to make sure we see our name in the registration information field. Now you can also make a new registration here if you wanted to gift I-bonds to someone else. But since that's not the case here, we want to simply plug in our desired purchase amount along with the source of funds. Now, source of funds is particularly important here because this is not only where we'll be funding our I-bond purchase, but it's also where the money will be deposited when you cash out your I-bonds. If for some reason you need to cash out your bonds to a different account, you'll have to go through the process of getting a medallion signature guarantee to add extra bank accounts to your Treasury Direct account. And that whole process of getting additional bank accounts added to your Treasury Direct account can take weeks. But anyways, the next step is to choose your purchase frequency. You can either choose a single purchase, repeat purchases that occur in fixed intervals, or you can actually choose a series of specific dates to purchase your bonds. Now I'm going to select single purchase since I want to lock in that 9.62% before it expires in late October. But with that said, repeat purchases can be really helpful if you're laddering your money into bonds like we talked about earlier. So now we click submit, where we're then reminded about the $10,000 purchase limitation. Click yes to proceed, and then we're presented with the final purchase review. Everything checks out, so we can now click submit. And now we're the official owner of Series I savings bonds. But if that process looked like a huge pain in the butt to you, there is a simpler, almost one-click alternative to buying I-bonds, and that's through Yotta. Now, if you're not familiar with Yotta, I talk about it in a prior video, but it's essentially a gamified savings account. So for every $25 you save, you get one ticket into their weekly sweepstakes where you can win various cash prizes. So Yotta recently came out with the ability to purchase I-bonds through their savings account, which no other company that I know of actually offers, since, well, it doesn't actually make them any money. Now, the benefit of buying I-bonds through Yotta is it's a simpler process than Treasury Direct, and it's easier to track the progress of your I-bonds, especially if you already use Yotta as your savings account. Now for me, I like the idea of getting my bonds directly through Treasury Direct, but that's not to say that there's anything wrong with getting your bonds through Yotta. Now, in order to buy your I-bonds through Yotta, you'll want to sign into the app and then navigate down to the bottom of the screen where you'll see the little bank icon. Now from there, if you don't already see an I-bond bucket like you see here, you'll want to click New, where you'll then be able to select I-bond bucket. Once you're in the I-bond bucket, you then have to simply click where it says Purchase, and then make sure you have the correct deposit from bank account selected, and then put in the amount you'd like to deposit. Now, I did see some Yotta users voicing their concerns about not being able to use funds you already have in Yotta in order to fund your iBond bucket. Yotta is actually forcing users to fund their iBond bucket with external funds, and this is likely because they don't want to lose the funds that people have in their normal savings buckets. So once you have the deposit amount filled in, all you have to do is click deposit, and then you're all set. As you can see, buying iBonds through Yotta was definitely a simpler process, and certainly something that's worth considering. And in this video, I talk about my favorite overall banks that provide stellar checking and savings accounts with the nicest perks.